first rates on your screen at the bell, right with the word go. 56 points higher for the Nifty. The market breadth is looking phenomenally strong, which is a surprise. Hero MotoCorp is on a tear. Another 40 rupees higher for Hero MotoCorp. Sun Pharma is looking strong. Nestle is looking strong. Tata Motors is looking strong. So autos are off to a good start. So we are pretty much starting from where we left yesterday, even though the market has seen a gradual decline of about 300 points, but there's nothing very sharp. ITC, the downturn continues after yesterday's massive sell-off or massive reversal. And for Hero MotoCorp, our technical experts were just alluding to that fact that where things are moving higher. SRF is down and out. Numbers were not that great. And if I have to mark some more stocks, say TVS Motor is bouncing back. So autos are in fine fettle. ITC is looking slightly rusty, and Nifty is off to a okay start, but mid-cap is where the excitement I think is there, especially in Hero MotoCorp.
Well, yes, and the mid-cap banking space as well as the PSU banking index, which is the top sectoral gainer right now. Remember, it had hit a 12-year high yesterday, so that continues today as well. You also have some real estate stocks which are doing well. So Lodha, DLF, they have started on the front foot. It's only FMCG which is on the back foot, led by the decline that we are seeing in ITC. But in terms of stock-specific action, watch out for SJVN. That stock is perking up 10% after that tie-up that has happened in Eastern India, and they are building up almost 50,000 crore worth of project. JK Paper is a result candidate, 4% higher. Aarti Drugs, that buyback support and a good set of numbers after that 16% rally today, is higher by 4%. Torrent Power as well, wherein they are setting up EV charging stations in Ahmedabad, is also started on the front foot. KPIT Tech will report numbers today. Ahead of that stock is fairly excited, has opened up in the green. Let's talk about the laggards then. DCM Shriram, clearly it was a weak set of numbers and the street is punishing that. It's also punishing the likes of Sharda, Cropchem, etc. Remember, Bayer has cut down their guidance, and for the entire chemical space, and of course the fact that SRF numbers were weak, it is having a bit of a rub-off impact. MRPL, Shoppers Stop are some of the other names which are in the red. So clearly, with respect to the market, it's an okay start. We're at 19,700, but the market breadth continues to be quite stellar. And in terms of the sectors, it's PSU Bank, Realty and Metals which are charging ahead.
Yes, indeed. Within those pockets, you have quite a bit of fervor, and within the broader markets as well, lots of names standing out. SJVN, Torrent Power, as well as EIL and SEAT among the lot. Let's find out what our chartists make of the move. And Kunal, your thoughts? The fact that you said that as of now it's time to take that little break, perhaps book profits, is that the strategy that one should be adopting, and what should be the first trade that you're punching in?
So the opening is as per expectations. I was not expecting too much of a flurry. I think even though the pre-open was showing 0.5% to 1% kind of an upward take, but I was expecting a more flattish opening, especially some muted opening for the Bank Nifty. In terms of opening stock, I would believe Sun TV could be a stock which could be looked out for. So we flagged off this trade sub that 500 levels. Now even at 535, 540 where it's trading right now, looks attractive for another 10 to 15 rupees on the upside. So 555 could be a target. And with that time frame, would suggest the one Sun TV.
Okay, Naresh, what's your outlook on the market open this morning, and what is it that you're looking at by way of charts on your first trade?
So decent open on the markets, time to play defensive, and those are the stocks breaking out. So NTPC is the one which looks closer to a breakout towards the new 52-week high. So that is where I expect a move towards 210. So that would be a buy for now.
Ajay Srivastava joins us now. Let's connect with him. Summer is over and it is monsoon. So is it time now to change your strategy also, now that the season has changed from summer to monsoon? Hello, sir. Good morning.
Good morning. How are you doing, sir?
All well, sir. Nobody is complaining in this kind of a market. But if somebody is not booking profits, is it a good idea?
Well, you said nobody's complaining. Ask the investor who was holding the stock in SRF, what does he feel like at the end of 6 months? So the market went up. So, while yes, there is a lot of euphoria, but I think stock specific, there has been a little bit of a problem for many stocks in the chemical sector, etc. So I think people who run the indices or actually did mutual fund this time came out winners than the stock pickers, because a lot of the stocks didn't really perform in the rally, and the laggards who everybody left behind were the ones which kicked in. So I think it's a great thing. The old favorites, they got retired this year, whether you look at Page Industries, SRF, etc., and the newest stalwarts like Dreamfolks, etc., came into play. So I think it's a great thing. Not that the market has gone up, but the new themes, the new companies are coming into play. And I think that shows the vigor of of the country or the economy to the extent that so many new theme in the market. Why waste time with the old guys? I think it's done and dusted. They may come back again, but the point is, I think more than the important is so many new players in the market. The choices have burgeoned like nobody's business, and it's become tough now to sit all night and read the results.
What are you doing in this market apart from playing golf and enjoying your Saturday night couple of drinks?
I tell you honestly, we moved to cash quite a bit now. We are almost 30% plus in cash at this point of time. And, we'll wait. We'll wait to see what happens to the market. So we've been happy with booking profits. We've been taking off weaker stocks off the table, focusing on a few select names and keeping them there. And we will wait and see what happens to this market, because eventually there is still, we can see all the buoyancy, global buoyancy in stocks. In India, and let's focus on India, there is still a big disconnect with what the fundamentals are, what the companies are reporting, and the PE expansion that has happened in them. I can't see any result. And the stellar result, let's say banking. If you see ICICI Bank, the profits on retail banking, wholesale banking, notably dropped in the June quarter compared to the March quarter. Yes, there is seasonality of March quarter, but still you had a degrowth in profits of these two main segments of the banking industry. Now that tells you a story of the market which is unfolding on the fundamental side. So you can ride the euphoria, but you can't fight the fundamental in the end.
Okay, that's interesting. Ajay, I want to come to maybe those specific stocks that you said you're sitting on. But first up, let me get in your thoughts on ITC. It's been the stock of the week, perhaps, given the fact that it's perhaps a case of buy the rumor, sell the news that pretty much played out. What's your view on how the demerger of the hotel business has shaped up?
See, I think it is a great move but it's a very marginal move in the sense that it doesn't really move the needle for an ITC investor. At the best, the market cap could be about 25,000 crore, which is less than 10% of the ITC's market cap. So I don't think it's supposed to move the needle. I think what the market got a little spooked was just keeping this 40%. We were all anticipating a complete demerger. Now the company is separate management, separate this thing. I think what unnerved the market and doesn't confuses the market is, why do you want to keep 40%? Let the shareholders have their direct equity holding directly in the hotel, and the hotel company works itself out, raises equity, debt, etc. Now what they have done, really speaking, what they've done is that this hotel company becomes an adjunct to ITC, controlled by ITC, cannot raise equity because it's unlikely ITC will dilute their equity holding, and a 40% being associated, the results also come along with this one. So in a sense, it raised expectation of a demerger, but did not do it. And I think that gets a pointer that somehow in the ITC management, that control phenomenon, I must control this, still remains. And therefore, what is unnerving is, why do you want to control this hotel company? Now, who's going to fund this hotel company? As Indian hotels did an issue, etc., preferential issue. Now, that is not going to be possible in ITC hotel. So I think they shut the growth windows, kept the control, and put the modicum of demerger onto it. So I think it's very disappointing for the shareholder. Not that it will move the needle very much, but I think the significant pointer was demerge completely. So we have a strong cash flow business we can own separately, and a hotel we own separately. That's not happened now at this point of time. This control, I tell you, this Indian management, this concept of control sometimes just kind of frustrates you as to what's the problem, man. Just run your company. There's enough to be done in ITC than to worry about hotels.
Okay, so that's a view coming in on ITC. Perhaps a different structure is what Ajay is suggesting. But Ajay, is power theme something that you would like to bet on? We are seeing there are various ways to do that, whether in terms of generating companies like SJVN, NHPC, NTPC, etc., financiers the likes of REC, PFC, and of course in the users, durables, polycab, etc. What's your view?
Hang me for generational company. I tried, burnt my hand. I'll be honest, like all good things, we should be honest to the market. That we tried our hand with it, that we are very bullish on power generation. India is going to be great. Consumption will go up. Market pricing will become free. Nothing happened at the end of the day. The companies are sluggish. They are non-performers. ITC stock, you can take it. Compared to what the market is, it's a dog, absolute dog, and it doesnn't go for them. Whether Startup Power, Adani Power, you just name the power company. So generation companies and an election year, unlikely for them to get any relief in terms of passing on tariff to the consumer, etc., etc. So I think power generation companies, I think, should be left alone at this point of time. I don't know what is the trigger for them at this point. Highest interest rate, generation requirement is, power requirement is much lower in the economy at this point of time. Government is not going to let you pass through so much of it. So I don't know, is there a trigger for them? I doubt it. I think we burnt our hands of very poor returns or maybe negative returns on some of them, and we won't touch it again for next at least 2 years till the elections are over. Now, come back to the point, we talk about Polycab, etc. I think these are specific stock stories. These are not industry stories because I think he's built up the portfolio on exports more than domestic. So I think there was a strategic compulsion in the company to go beyond domestic, and it's paid off very well. So, it's not an industry symptomatic, it's a very company-driven strategy which came out well. I'm not sure it will come across all the companies in the industry, but certainly to extent that degrowth that we see in most companies, that won't happen. Whether you need to buy at these prices, valuation, I would doubt very much, except after yesterday's China news, perhaps it's some more good news for companies like Polycab. But, it's going to be difficult for them to replicate these kind of returns of a strategy which paid off so beautifully in this quarter.
Ajay, for the first half of this year, the typical growth names have made a comeback. That's been the global experience. Whether it is chip, AI, internet companies, Paytm here, followed by Zomato. Second half, time to ride growth or time to look at value? Because interest rates have peaked out. Inflation is coming back. Crude has popped up. So is it time to now look at the other side of the spectrum?
See, the problem is, where do you search for value? Everything is so expensive. You just give me 5 names. I would ask you to give me 5 names who you would think is today value stock. Very difficult to find quote unquote value stocks. But I still believe, stick to the themes, I think, and that's the more important one. You got to have your convictions, stick to themes more than stocks. And I think what you named, some of the online stocks, some of the stocks that relates to, we spoke about the launch company, which I am holding in. These are newer themes emerging. Defense themes have done extremely well in the market in the last 2 years and continue to perform very well because of scarcity. So I would still say stick to the themes, stick to stock specific. Yeah, and you got good quality groups. Like for instance, South-based group, which has got an automobile, which has got an e-mobility, which has got an infrastructure. Why don't you put your money behind them? And because they are doing a very smart job of 2 decades, 3 decades of generating shareholder value. So I would still say, don't look at value, look at highest performing industrial groups, what they have done, continue to back with them. Don't worry about it, that they've gone up so much, because they will go up a lot more as India expands. Inflation will take it up by 6 to 8% year on year, so not to worry about that. So I am not of the view that one should change a strategy at this point of time, but I think you need to prune your portfolio down and back the winners. You saw how well a very large, let's say Poonawalla FinCorp, how well it has performed since it's taken over by a guy who's performed so well in, Serum. So, when you back a promoter with a given track record, I think you are in a much safer hand. Same happened with what happened in the hospital, Max Hospital. So I would say this is a time, back your theme, back your conviction. Don't need to buy everything in one day, but keep a watch list, keep adding up to your portfolios. Don't prune the good ones because the market has gone up. Prune the bad ones, the one results are bad, potentials are bad. And P's are not crazy. As we discussed, some of the retail P's, for instance, why would you buy a company which is degrowing at a P of 150? Now, somebody's buying it, market is saying it, but it's nutcase value, nutcase investment, I call it, thesis in this country. There's some of the stocks that don't grow are running at P's of 100 plus. 100 plus P's, Google doesn't get it, Apple doesn't get it. And we give it to retail companies in India. It's crazy.
I think he's referring to perhaps a business which is backed by Radhakishan Damani. And it's a business which is contracting given what's happening to value retail in India per se. So Ajay, for the moment, if you have to, let's say, look at the most overrated sector and the most underrated sector, which one would that be?
I think the most overrated sector too is retailing, certainly by any chance. Retailing, fashion wear retailing, most overrated sector. General retailing, most overrated sector. You saw the Reliance results. You've seen Trent. You've seen, Avenue you just spoke about. Just see their performances versus what the market valuations are. I think the most overrated sector, in my view, at this point of time, among all the sectors that I see in India. And I think if you were to look at what is really the underrated sector, nobody buys it. I do not know why. Paper. P's of 3 and 5. Incredible, even after this expansion, highly profitable companies, 3 or 4 companies run this whole market in India, and the P's are less than 5. I have not seen this. I do not know why it is so. And it has continued for year after year. It's not like it's a one-time phenomenon. I have no clue, I'm sorry to say, why it is happening there. But you ask me what's the most underrated sectors, paper, PE of less than 5, highly profitable, duopoly, literally, no competition, necessary of life, but still the P is 5. Such as market, fashion retailing gets P of 120, essential profitable business of paper gets a P of 5. That's market, my friend.
Oh, well, yes, that's market definitely. But for the day, at least JK Paper is doing all right. It's 7% higher on account of the earnings. But Ajay, on that note, we'll let you go. Thank you so much for making
Thank you
time and
very
staying
much.
with
You
us.
have a good day.
You too. Thank you so much. But shifting focus, earnings, that's talk of the town. So let's welcome on board Mr. K. Raju, the MD and CEO at Canara Bank, to talk to us about their earnings, because it was a decent set that the company reported yesterday. But let's see where they go from here on. Hi, sir. Good morning. Thank you so much for making time speaking with ET now. To begin with, your cost of funds have risen quite a bit in this quarter. What's your own estimate? Where will the cost of funds peak?
Already this cost of funds is increasing from the last October onwards. We started paying the higher rate of interest from October 6th. So the current, we already reached that interest expenses to the peak, to the whatever we have spent as the expected level. We have already achieved to that peak level. But the only thing, the current quarter also, that high interest rate regime is continuing. So in the current quarter, whatever the resources we mobilize in the form of term deposits may attract the same rate of interest. That's the reason actually we want to take benefit out of whatever the cushion we have in the form of a lower CD ratio. That we want to feel that we want to go beyond the 75%. The second one is we are focusing more on our CASA with innovative products, which already we launched on the first working day of the current last June quarter, and that has started giving some results. Whatever the new products we initiated, it has contributed to our balance sheet around in the last 4 months 3,300 crores, and we continue to focus on those initiatives, new initiatives targeting for the CASA. And the bulk deposits, we could reprice it when the interest soften was there from May 15th to June 30th. That is giving some benefit to for this quarter. The current quarter also, July onwards also, we have seen that in the market, the liquidity issue is there. So automatically the rate of interest will be high only. It will continue. But it will not impact on us. Already we feel that we are already reached to that maximum level. At that level, it may continue. Little bit here and there.
So NIMs have slipped in this quarter a bit going forward. Where do you expect NIMs to ultimately then settle?
For entire financial year, we are given a guidance of 3.05 NIM in the initial stages, sir, for this current financial year. In line with that, last year our cumulative NIM was 2.92. The current quarter, we could able to show that the NIM of 3.05. Though there is undoubtedly, let me say that there is a stress on the interest expenses because of a higher rate of interest. But even then, since 52% of our portfolio is MCR linked, and this MCR linked is giving a good interest yields on us advances, even the repo rate comes down gradually. That will impact only 34% of our advances. So that's the reason we don't see any fall in the NIM below 3%. We are confident that we can manage at 3%, around that 3%.
Okay, Mr. Raju, your advances growth has been stronger than the guidance that you had given. Does that mean you will now revise your guidance upwards for FY24?
During the first quarter, we are given a guidance for this current financial year that our advances growth will be 10.5% current year. But when I was interacting with all of you, I expected that our credit growth may be at 12 to 14% range. In the first quarter itself, when we in the domestic credit, we can record a more than 3%. That itself shows that the whatever we have promised, that given the guidance that the 12 to 14% range, the credit growth, that can be easily possible, sir. We can ensure that our credit growth will be about 12%, in the range of the 12 to 14%. And the first quarter itself, we are given the year-on-year growth is 13.75%, 13.27%.
Okay, point taken. But we do understand that Finance Minister also met with a lot of PSU banks. I just wanted to get a sense from you as to what was exactly discussed, because there seems to be some sort of caution or red flag which has been raised regarding unsecured lending. Anything specific for Canara Bank?
I can speak about only Canara Bank. I cannot speak about all other banks about the unsecured advances. Our unsecured advances are very, very limited, especially in the retail sector. The concern, what the expression is, unsecured retail loans growth. It has crossed the industry. It is from earlier 23% to 25% something. But in our bank, the unsecured loan portfolio under the retail is linked with only the salary crediting people. We are not extending any our unsecured loan to the other guys who are not having a regular income. And we are also not giving to any other outsiders who are not our existing customers. Our product has been redefined. It has been little bit flexible. We made it. Actually, earlier we used to give the package for the department wise. Now we merged all the 1100 packages and we are given a comprehensive package to products Canara budget for government employees and the private employees. This scheme has attracted very well among the people, and we are also simultaneously aggressive in canvassing the salaried class for opting our Canara Bank as their salary dispersing bank. This product has got traction among those people, but our unsecured loan exposure will be confined only to the salaried class who are drawing their salary from our bank. So I don't see any threat or anything, though there is a good growth in this, but our base volumes itself is very nominal. Our volumes are only 7,000 crores in that area.
Talk to us about corporate loans again in this quarter, as we hear commentary from HDFC Bank suggesting that there is some mispricing in the loans.
From Canara Bank side, corporate pricing, there is no compromise on that. Now we are very much sure that being a big bank, one among the top 4 banks, we play a vital role on every corporate's growth history, growth story. So that's why every corporate wish to deal with us, but we are very much concerned about our pricing. We are not compromising for the just like that to show a top line growth. So last year we have grown when we have an ample liquidity in our system, when we have an the more than 40,000 crores liquidity in our system, which is outstanding, just the ideal liquidity that for effectively we invested in the last year first quarter. That is for short-term investment we made. But now the last quarter onwards, we started repricing all those things. We don't mind. We have actually 1 or 2 AAA rated companies. We have taken it back that whatever our exposures when on the maturity, we have not renewed those accounts, because unless otherwise we get that our desired pricing, we are not lending to and throw away for the just like that to reach the top line business. At the cost of bottom line, we are not lending any to the top line. But there is an ample scope. There is an ample demand for the credit. We already almost every month on an average 12 to 15,000 crores worth of proposals, new sanctions, it is happening in our bank. So last 4 months, we already did almost 55,000 crores worth of sanctions. So there is ample scope. So we are keeping the price as well as the rating or the credit rating of that company, both in mind. We are picking suitable to our balance sheet.
And also on the ECL front, is there an assessment that has been made on the impact of the ECL implementation?
Last time when we have shared with the analysts and all, that was a rough calculation what we made. Then thereafterwards, we sought many clarifications from the regulator and we got many clarifications out of that. Based on that clarifications, we have recalculated our requirement and it has now come down to on an average, it's a 2.25% of our requirement additional coverage that may impact only to that extent. For further guidance for us, till it comes for that final draft guidelines, before it is implementation, we want an expertise to be taken from a consultant, and we have gone to the market for onboarding the consultant. That consultant, it is being onboarded. We sure that with their expertise, we will further fine tune our effect on this ECL. It may be around 2%.
Okay, so the ECL impact could be around 2%, but sir, you've already touched your return on asset target, which was at around 1%. What next?
We are given is 1%. Our guidance to the initially when we started this financial year, for current financial year, we are given a guidance of 1% return on asset, and with all our efforts and the initiatives, we could achieve it 0.99 in the first quarter itself. One thing we are sure that we can easily achievable that 1% return on asset. But further anything is that this is only a minimum what we communicated to you. Our achievement will be above than that.
Rishi Vora, Vice President, Kotak Institutional Equity joins us now. Let's connect with him to understand that what's happening to the auto space and how things are moving in the sector. So Rishi, good morning. Thank you for joining us. Auto is emerging to be the sector of the year. At this current juncture, how do you think the risk-reward ratio is stacked up?
Over the last 2 months, auto sector, or let's say over the last 1 quarter, auto sector has seen a decent rally. And to that extent, valuations of most of the companies which we cover, are above the average levels. Most of the recent optimism that has come in the auto sector is predominantly on account of correction in the commodity prices, given the weak economic outlook from China.
Okay. Is it, I think we lost him there, just a bit of a rain here and there. Auto is turning out to be the sector of the year. A lot of factors. First, raw material pressures are behind us. SUV sales are doing very well for four-wheelers, which is the high margin business. See, the migration is clearly happening from small car to EVs, which also is great news for for companies, because one side is this migration from EV, but EV in a sense is one space where that because of innovation, battery cost coming down, accessibility, affordability, and the desire for consumer to own EV, they end up paying more. And then you got real revival, which is there in the CV space per se. So Rishi, we lost you there when you said that auto companies are commanding averages above their 5-year average.
Yes. So yeah, first I was talking about the tailwinds from commodity, which is helping the sector. From demand perspective, things are slowing down a little. At least it's not widespread demand recovery which we are seeing. Select pockets continues to outperform SUV segment in passenger vehicle, or a premium segment in motorcycle continues to do well, whereas the entry-level cars, economy motorcycle segment continues, demand over there continues to remain weak. Culprit being steep increase in cost of ownership over the last 3 to 4 years. Demand outlook, I think I'll be a little bit, cautious now going forward. As last year, especially on the passenger vehicle side, there was a lot of pent-up demand, which was there in the sector itself, given there were supply challenges. Now, most of the situation on the supply side is getting resolved. And additionally, my sense is that on the inquiries and the booking levels, momentum is slowing down a little. So on the demand trends, I'll be a little cautious, going forward. But yeah, margin side, as of now, things are looking fine for the sector. But yeah, from that extent, overall, the valuations have jumped up, and I think the risk reward at this juncture is a little bit unfavorable.
Okay, so that was about the entire sector, and yes, as you pointed out, right from an M&M to a Bajaj Auto to a Tata Motors, they've run up anywhere between 25 to 65%. So given this context, Rishi, which are the stocks that you see still have a bit of re-rating trigger going forward? Do you see which is the stock which sees the maximum upside within your coverage?
I like M&M, Mahindra. We still believe that there is valuations scope to further re-rate from where they are. Company has done well over the last 3 years. Their UV segment portfolio has been revamped, and they are the leaders in terms of revenue market share in that segment. Also, there were issues on capital allocation, but with Mr. Anish Shah taking over as an MD, a lot of corrective actions have been taken, and they continue to improve and be tighter on capital allocation. So, if I look at their multiples, the company is currently trading at 16, 17 times core EPS 2-year forward, which I believe is, there is a scope for multiples to re-rate from where they are, can go till 18 to 20 times. So at least amongst the companies which we cover, I think M&M has still some scope for multiples to re-rate from where they are today, despite the sharp outperformance which the stock price has given over the last 2 to 3 years.
What's the outlook as well when it comes to the new launches that we've seen, the focus on EV? How do you believe that auto companies will be able to leverage this? Are we still a long way off? And which are the companies that you think will be able to really capitalize on the EV opportunity?
Starting with the passenger vehicle segment, EV has picked up, let's say, at a slower pace. The penetration is around 1% currently. Over the coming years, we expect EV penetration to definitely pick up because in terms of technology, it is the right technology, we believe. And obviously, it's a much superior, the performance of a EV car versus any, let's say, in India today, it's a much superior performance. The only issue right now are the and second is the infrastructure. Multiple OEM, in FY.
Sure. Rishi, apologies. We have you on a bit of a scratchy line, so we'll have to end the conversation a bit short. Thank you so much for making time and speaking with us. For the market, it's doing all right. The Bank Nifty has scaled past a level of 46,000, so that's doing okay. In terms of the Nifty itself, let's see where do we stack up. It's still below 19,700, but within the market itself, a lot of sectors which are showing quite a bit of leadership. Metals being the top leader today. That index is up around 1.5%. Of course, there's this tailwind that happened with respect to the announcements coming in from China that they're going to support their property sector. We have heard about it often enough, but nonetheless, the metal sector is reacting to that. Over the last 5 days, we had seen that there was a bit of a disappointment in terms of how stocks were moving, so they were ripe for a rebound, and that's exactly how it's panning out. You have Jindal Stainless up 3%, JSW Steel high by around 2%, and SAIL too sitting with a gain of around 2%. In terms of the other stocks and sectors which are doing okay, real estate stocks are doing all right, and then the power names like SJVN, Aarti Drugs, etc. is something that we are watching out for. But what are the mega trends that are emerging in the economy? Listen in to what Vinod Khosla, the founder and managing director of Khosla Ventures, had to say about that.
Normal areas are marketing, selling, advertising. AI is playing a big role. Content generation is another very interesting example. Content creation, whether it's for advertising or brand use or games. So almost any area is possible, from entertainment to fusion reactors. The other areas outside of AI are worth talking also. Climate change has created a lot of opportunities. We've seen lots of weather disruptions, and the world is very, very serious in the transition away from fossil energy and fossil non-sustainable technologies. So that's an opportunity in India. Robotics, manufacturing, supply chains, those are all very promising areas that can be done out of India. What India should do is take manufacturing expertise, use engineering talent to reduce the cost of manufacturing, because the world won't pay more just because it's outside of China or made in India. And so you have to get the same cost, and you can get there by either having lower cost labor or having lower cost engineering talent that reduces the manufacturing, the labor content of manufacturing. And I think that's a better approach for companies in India to take, because there's so much manufacturer talent available, engineering talent available in India. So, and I do think that'll be a superior approach. So using robotics more, using automation more, and using talent to develop those processes.
Rakesh Arora joins us, and lots to talk with him. Rakesh, first let's start with a sector which you've tracked very, very closely, and I'm assuming you still continue to track with a microscope and a telescope. That's cement. Just when it appeared that the worst is behind us and margin pressures are abating, the numbers which have come from Dalmia and Ultratech do not inspire too much of confidence.
Yeah, I mean, there's been a little bit of disappointment. It looks like that, when the energy scare was going on, companies hoarded or actually entered into contract to ensure supply. And that's why the high cost inventory is still not out of the system. In first quarter itself, petcoke prices have dropped by 19%. and coal prices are down 11%. So the benefit should start trickling in from Q2 onwards. So it's just a delay of a quarter. I won't really read too much into it from a medium-term perspective.
Okay. But the fact that this year we have erratic monsoon, extension of monsoon, rainfall, I mean, Mumbai it always rains, so nothing new. But North India is where the rains actually have been a bit of a spoiler and activities completely out in terms of construction. So do you think this quarter also revival is unlikely?
So see, monsoon is always like this, slightly up and down. But industry is talking about a 15% volume growth this year, which is kind of unheard of, a very high number. So good monsoon is actually has a tailwind because rural demand tends to pick up post good monsoon. So I think good monsoon is welcome, and a minor shift in volume from say July, August to September, October is actually augurs well for the industry.
Sure, but Rakesh, that 15% growth expectation, would you call it realistic? Because at the start of the year as well, the companies tried taking some price hikes, but they had to partially roll it back because the demand wasn't supportive enough. What's your own estimate? Do you think double-digit growth is possible in volumes?
See, currently the industry is operating at a very high capacity utilization. So if you heard the Ultratech call, they are operating at 90% capacity utilization. So with this kind of capacity utilization, there would be some unmet demand in the market. So I'm expecting cement prices actually go up post the monsoon and may not really fall that much even in the monsoon. And with this cost support coming in, probably the dip in margins that normally we see in cement industry during Q2 and Q3 may not really be that harsh. So overall, I think things are looking positive for the cement sector, and I think demand would remain pretty strong in run up to the elections next year.
What other stocks do you think that might see the maximum amount of upside from here on?
In terms of stocks, you're asking?
Yes.
See, while I can't discuss, target prices, etc., but large pan-India cement companies are going to be a beneficiary as compared to regional plays, because regional plays can see a little bit of an up and down given the local dynamics. So I would prefer large cap companies with pan-India exposure.
The dynamics of the cement sector, which were expected to change because of Adani's entry, has not changed. Will that be a fair statement?
No, so there has been a little bit of change given that there's a little bit more aggression by the existing players, and that is one of the reasons why cement prices didn't really go up in the last 2 quarters as much as they could have gone up given the demand and the capacity utilization. But this is a passing phase because people were expecting margins to recover in any case because of cost reduction. And so even without the cost reduction, say Ultratech is doing 1,100 rupees per ton margin. As the cost pass-through happens, these companies will be doing around 1,200 to 1,300 rupees per ton. So that's a very healthy margin which the industry is maintaining. And so Adani's entry has only, I would say, created a little bit of excitement and more, aggressive capacity creation. But, beyond that, nothing much has changed.
What is your understanding of how things have moved 6 to 1 year ahead of the election year for the cement cycle per se? General belief is election, more spending, more infra, more roads, more bijli, more pani, and more cement sale. Is the logic in believing in that?
Yeah, there's evidence over the cycles that pre-election there's a huge rush to complete projects, and that's what we are seeing exactly happening right now. And if the monsoon is good, there will be tailwinds from rural demand also. So FY24, I'm pretty sure that is going to be an extremely strong year in terms of demand growth. Demand might peter down a little bit post the elections. So 6 months after the elections, things can slow down a little bit. But in run up to the elections, I think there's no real worry on the demand front.
Real worry on the demand front. I just wanted to shift gears a bit and discuss the metal space as well, if I can, Rakesh, with you. Your reading of the Tata Steel numbers, and do you see the merit in these headlines coming in from China that they are looking at supporting the property sector? Do you think this would be enough to spur the metal demand globally?
So Tata Steel results were weak as we had expected. And going forward also, I don't really see any major improvement in margin coming through. There's a little bit of cost reduction coming in, but at the same time, steel prices also gone up. Now, overnight, China's Politburo has said some soothing words about supporting the economy, etc. But there's no real details in terms of both monetary and fiscal, stimulus that they are willing to look at. And as per our, understanding, it will require a lot to really move the commodity demand in China. One, they really need to breach that 3% fiscal deficit target they've been keeping for themselves. So they really need to go out and spend money, kind of a quantitative easing. Number two, they really need to, change the stance on the housing sector. Since 2017, they've been saying that housing is for living and not for speculation, and that has really led to, a little bit of burst of the bubble, and the bubble is still, pretty large, so it will take long to normalize. So until and unless government really changes the stance on the property sector, we don't really see demand picking up. So there would be a little bit of sentimental pop, but we need to see a much more aggression from the China to really get excited about commodities.
Crude is moving higher. Dollar index is also in the right direction for commodities. Nobody has very strong bullish view on metals right now. These are typical times when you are contra buyer in metals, you end up making money. I mean, is there logic in this argument?
The only issue is that the stocks are not cheap. So already stocks are factoring in a mid-cycle earning, and that is where the earnings are also. So just to give an example, Tata Steel yesterday reported around 6,100 crore of EBITDA. So that's a run rate of 25,000 crores. Street is sitting at 32,000. And if I do a 6-time EV/EBITDA, the EBITDA which the stock price is building in comes at around 58,000. So, there's a large disconnect already. Stock prices are building in a lot of optimism of, at least mid-cycle earnings, and whereas earnings are actually lagging behind even what consensus is building in.
In general, what is your view on the market? Do you think best of the gains are behind us for the year?
See, we are definitely in a zone where greed has taken over. But from Indian perspective, if I see half of the market, which is financials and IT, both are not really too expensive. Financials are kind of trading at their long period averages, and IT, despite all this, weak results, they're not falling that much, and they are also trading kind of long period averages. So if half the market is really not expensive, I don't expect markets to fall apart. I think 1 year target is closer to, I would say, 21,000 for the market, but there could be variations between that.
Okay, so that's the word coming in. Thanks, Rakesh, for making time and speaking with us about cement, metal, and a whole host of other topics as well. But metals definitely the shining star today because that index is the top sectoral gainer with a gain of 1.5%. Pull up a Jindal Stainless, an APL Apollo, a Hindustan Copper, JSW Steel, Hindalco. They're all sitting with gains of anywhere between 2 to 4%. Of course, Tata Steel was the stock which opened on the back foot, but that too has made up. In fact, if you pull up the intraday chart of Tata Steel, it's sitting, I think, at the highest point of the trading session now with a gain of around 1.3%. It started on the back foot, but has pretty much made for the losses and is now comfortably in the green. But apart from metals, it's the financials which continue to be the talk of the town. So let's welcome on board Mr. Girish Kauski, the MD and CEO at PNB Housing Finance, joining us on the show. Girish, hi, good morning. Thank you so much for making time and speaking with ET now. Just wanted to begin by understanding what's happening with respect to loan growth, because if I have it right, the annual target that you had suggested for the year was a growth of around 17 to 18%. But this quarter, it was a little slower at around 11%. We do understand the seasonality, but would you be confident about that target of 17 to 18% growth?
Good morning. I think if you look at any year, quarter one would be muted, both in terms of asset quality as well as growth. So 11% growth on book is in line with our expectation, and the guidance, for the year is about 17 to 18% of book growth, and we are pretty confident because this is something which at least I am seeing for last over 20 years. So quarter one would always be muted after a very good quarter four. I think in any year, quarter four is the best quarter, and after that, quarter will be muted, and again it picks up from quarter two onwards. So if you look at demand is quite robust. We are seeing good traction across. It's only because of seasonality, the book growth is 11%. But if you look at 11%, this 11% book growth is the highest in last 15 quarters. And if you look at last couple of quarters, both the book growth and disbursement, it has been really amazing.
Okay, you sound very optimistic. So, Girish, given the fact that there is a report that recently suggests that affordable housing continues to languish and you forayed into this segment, take us through how you have performed so far and what is your projection going down the line? Are you as optimistic?
I think if you look at the market and if you have to segment between both prime and affordable, I think affordable constitutes to close to 35 to 40%. And for us, at least, quarter one was very good. We showed a growth of 66% over the previous quarter. And we are pretty bullish on affordable and prime both. Yeah, there are reports, which talks about affordable demand slightly going down. Again, I would assign this to seasonality. Otherwise, if you look at the entire year, whether we look at short term, mid term, or long term, both prime and affordable would offer good opportunity in terms of demand.
Okay, sure. But there's also that component that a lot of these companies, HFCs, have been facing a lot of competition from banks. So how competent are the yields that you will be charging on the incremental loans that are being disbursed?
I think if we talk about competition, basically there are four segments: super prime, prime, affordable income based, affordable informal based. So if you look at super prime, that is where there is competition more by desire. So most of the banks would want to focus on super prime, where it is more by desire, and affordable is more by design. So we are very clear. Our focus is very clearly on the prime and affordable income. In these two segments, though there is competition, we don't see a significant competition, and therefore, it really fits into our scheme of things in terms of growth as well as profit.
Okay, so that's the take coming in. But just wanted to understand that going forward with respect to the profitability and cost of funds, etc. as well, given all of those dynamics, what's the expectation of how the net interest margins, etc. would shape up?
In terms of margins, both spread and NIM would be in line. So we had guided for 2.5% spread and 3.5% NIM. As of now, we are at about 3.86% of NIM. I think this will be sustained, for next few quarters. I think on margins, we will be able to sustain, based on what we have guided. In terms of growth, I've already mentioned. And in terms of revenue, there'll be a good upside for next few quarters because the rates started going up last year, and this will now consolidate for next 2 to 3 quarters before it starts going down. So I think next few quarters is going to be really good for HFCs and NBFCs.
What about a very basic question that if I look at rural economy, all data points are indicating that there is a slowdown. Cement companies are saying the same, auto companies are saying the same, even retail companies like V-Mart and D-Mart are saying that rural economy is slowing down. Won't that impact your demand? Won't that impact housing demand and cost of affordability eventually?
Actually, if you look at the entire industry, all the institutions, both in formal and informal segment, they're not really catering to rural per se in a big way because of the challenges, on collateral, zoning, etc. So I think the focus today, if you look at any company, is going to be probably in top 200 or 250 locations, which is top cities and next few towns. So I don't see too much of a challenge because the focus really is on urban and semi-urban. We call it as tier 2, tier 3, tier 4. I think in these locations, which is not actually rural. So very few companies to a very small extent would focus on rural, but given the challenges in this industry in terms of various approvals which is required and the zoning regulations, not many companies have really ventured into it. Probably, I think 10 years from now, rural also would start contributing, but at this point in time, it is more to do with metros, top cities, and small towns, which is tier 3 and 4. So I don't see any challenge because of rural really not contributing, at least in the farming sector.
Builder loans. What about loans to developers? Are you looking at expanding that? Because if I look at the metros, the demand for urban housing, the channel checks indicating that the Indian urban buyer is looking at buying more houses, and developers are also telling us the same thing.
Yeah, if you look at the real estate space, it is doing pretty well since last 2.5 years, immediately after COVID, which is from 2020 October onwards. But yes, our focus as of now is to grow retail. A corporate book, consciously we are degrowing and we are working on resolutions. We still have a bit of work left in terms of working on resolution and bringing down the NPA. Even though I think corporate, which is funding to developers for projects, offers good scope for the HFCs, we would not be really focused on that for next few quarters. Our focus is really on retail, within retail, on both prime and affordable.
Focus continues on retail, but just wanted to get a sense from you about the asset quality, because of course in the quarter gone by you've managed to show a bit of an improvement, but how's the asset quality panning out on the incremental loan book going forward, and what's the internal target?
All the early warning signals on the incremental book, what we're building, is very, very encouraging. Having said that, we also have to deal with the portfolio what we have. I think we have very good traction on that. And probably in next 4 to 5 quarters, our asset quality would be comparable with some of the best companies in the industry.
Coming in as far as PNB Housing is concerned, but just sir, also a word on the return on asset, because it's already at a decadal high if we have it right. Could you talk to us about what will be the normalized return on asset going forward as well?
See, our focus is very clearly on few pillars. So starting with asset quality, profitability, growth and liquidity. Now we have a mix of both prime and affordable. Prime will help us to grow the book faster. Affordable business would help us to improve our yields and thereby maintain margins, or rather probably further improve. So I think looking at next few quarters, our return ratios, including ROE, would look very, very good.
So that's a word coming in. The ROAs are looking good, not too worried about the asset quality. And of course, this quarter, the seasonality came into picture for loan growth, but on track to achieve the targets that they'd set out. Thank you, Girish, for joining us and speaking with ET Now. A quick look at the markets before we head into that short break. We have Nifty, which is at 19,685 thereabouts, not managed to scale 19,700 yet. We'll do one thing, we'll slip into a very short break, but don't go anywhere.